Welcome back to Rich for Purpose. In this video, I'm going to be talking about what is a call option and how can we use them. I wanted to shout out Kaiser Royce because he said, "Can you please teach me about calls and how to use them?" And I would love to do that. I love questions, so keep the questions coming. If there's anything I can answer for you guys, I absolutely love it when people are trying to learn more about this stuff. So, what is a call option? Let's dive right into it. I made a bunch of slides, a bunch of examples, and I'm going to try and explain this to the best of my ability for you guys. So, what is a call option? A call option is when you buy a call option, you're paying a premium for the right to buy 100 shares of a stock for a set price, which is a strike price, on a set day, which is considered the expiration day. If expiration date comes and the stock price is under the strike price, the option contract becomes worthless and you lose all the premium that you paid. If expiration date comes and the stock price is on or over the strike price, then you can exercise your option, but you're not obligated to do so. So basically, the premium is just the price. The strike price is the agreed price, the price agreed upon. And then the expiration day is just the day the contract expires. So let's dive into some examples of this. So this is Trivago. I got 4 of these and 10 of these ones. So this is how this works. So right now, Trivago is sitting at $3.38. So right now, I could pay someone $93 because this price here, you times it by 100 because this represents 100 shares. So I could pay someone $93 for the right to buy 100 shares of Trivago at $2.50, right? On February 19th. So, say February 19th comes along and Trivago's sitting at $3.38. I could buy these 100 shares off of him for $2.50. However, my break even price would be $3.43 because 250 plus 93 equals 343. So I would technically lose on that trade. Now let's say we want to buy 100 or we want to buy a $5 call. It would only cost $33. I would have the right to buy 100 shares of Trivago at $5 on Friday. Now, what happens if it's not $5 by Friday? Then that means this contract becomes worthless and we lose our $33. So to show an example, when I bought these were at $8 to $10 each. So I got 10 of them for $10 each, right? Since Trivago's price ran up a lot, these contracts go up as well because the likelihood of it hitting $5 by expiration day went up, so the contracts go up. And being that I paid $100 for these and they're now worth $330, I'm up 230%. And that's how you can kind of leverage your money more than in some cases than buying just straight equity in stocks because each contract represents 100 shares. So let's look at another one. So this is Senseonics, ticker symbol SENS. I own 100 shares of these. I paid $2.22 for 100 of these shares. Now let's look at the option chain though. So I own 5 of the $3 call options. I believe I paid $70 for these. I paid $70 for the right to buy 100 shares of SENS for $3 each share. At the time, it was $2.22, but right now, it's at $4.20. So, come Friday, if it's above $3, then I have the right to buy 100 shares of Senseonics for $3 off of whoever sold me this contract. Now, let's say I don't want the shares because I'm not obligated to buy the shares. I just have the right to them. I can then sell that contract to someone else. So right now, if I wanted to sell this contract to someone, I could sell it for $118. I paid 70, but now it's worth 118 because the current stock price is at $4.20. So you have the right to buy the shares, but you're not obligated because you can always sell that contract to someone else in the open market. And that's how buying but these are very short term. There's another layer to this cake here, is expiration date. So this one expires this Friday. Now, the more time you go out, there's going to be a time premium added to it because the chances of it hitting that price by that expiration date are greater. There's a little bit of time premium added onto that contract. So that's another thing to keep in mind. Now, what are covered calls? So here's what I love about options is I can buy the calls, right? And then I can either exercise them on expiration, or I could go ahead and sell them off and make a profit on those contracts. Now, if I own the underlying stock, 100 shares of that stock, I can go ahead and sell covered calls. And when you sell these contracts, if you own 100 shares of a stock, you can sell a covered call contract to collect the premium. So you know that premium you're paying when you're buying the call? You're allowed to sell a call and put up 100 of your shares as collateral. You put up 100 shares of as collateral, and if on expiration date comes and the stock is under the price, then you get to keep your 100 shares and you get to keep the money that they paid you. If expiration date comes and the stock is on or over the strike price, then someone would have the right to buy your 100 shares off you on that agreed upon price. So for an example, for a covered call, I sold a covered call on Snapchat. So here's my Snapchat position. I have 125 shares. I paid $15.72 for 125 shares of Snapchat. Now at the time, I think it was like $30 when I sold this, right? It was at $30. Someone paid me almost $700 for the right to buy 100 of my Snapchat shares off of me for $42. And it's kind of like a no-brainer. Like, well, I paid 15. It's at 30 now. Someone's willing to pay me $700 for the right to pay me $42 a share. So I sold that covered call for $700. Now, on January 21st, 2022, when that comes around, whatever the Snapchat's at, they'll be able to buy Snapchat for $42 a share off me. Right now, Snapchat's at $61, so this is a pretty valuable contract to have. If I didn't want to get rid of my Snapchat shares and I wanted to get the rights to my shares back, I would have to pay $2,423. Now, the reason I'm not worried about this and I'm not going to do it is they would have no reason to exercise this contract right now because they can just let that option sit there, and as the stock moves up in price, so will that contract, and they wouldn't need to put the cash up to buy the shares right now. They can wait. Now, when I get closer to expiration date, if Snapchat's still at 60, 70, whatever it's at, I could just roll this contract over. So I could go further out, more time and more money further out, and buy this contract back and then sell another one and just keep rolling them out. And eventually I could just sell my Snapchat shares because I bought them for $15 and I'm making money either way. But this is how you could kind of lose in a way with selling covered calls, is if the stock price goes way above what way above what the strike price on your contract is. But being that I only paid 15, I'm still gonna win. It's just I'm leaving, $2,000 on the table. So I'll just keep rolling this out. Now, another aspect of call options is credit spreads. So what is a credit spread? A credit spread is simply just buying a call and then selling another call further out the money in one transaction. This will reduce your cost for getting exposure to a stock's upside, but it will also put a limit on how much money you will make, a max gain. So an example of a credit spread is this one here, Corsair Gaming. I bought a $40 call expiring on Friday, and I sold a $50 call expiring on Friday, the same transaction. I paid $269 for this. Now my max gain, because it's a $10 spread, my max gain is $1,000 gain. So how this worked was I spent $388 for the rights to buy 100 shares at $40 each, and then I sold a $50 call for $41. So 41 minus 388 is 269. So now, say by Friday, Corsair Gaming is at $50. My max gain would be $1,000. But say it's at $55. My max gain is still only $1,000 because someone has the rights to those at 50. I have the rights at 40. Someone else has the rights at 50. Now say Corsair Gaming's at 45. What happens then? So what would happen if it's at 45 is I would have the right to buy them at $40, and the 50 become worthless. So those expire. So whoever bought those off me, as expires worthless, and I can either buy 100 shares for $40 or I could sell this contract for $500, because if it's at 45, the spread would be $5 spread, so I could sell this contract for $500 and this one would become worthless. So that is how a credit spread works. So I hope this made sense to you guys. I can break this down and make it a little bit easier to chew, or I can present this to you guys in a better way. But if you guys really want to learn a lot about options, I would like to share with you the place where I learned it, and it is the Trading Fraternity. So I'll leave a link in the description below for the Trading Fraternity, and you can learn a lot from there. And then I can make more content and more videos about it as well. So I hope that made sense. I hope you learned a lot. Thank you for watching. God bless you guys, and I will see you next time.